Esto es pa' que te enteres, este es el detalle. Si caliente está la cera, más caliente está la calle. Mira, llegó el son cubano.
Hola mi gente, welcome back to the channel. My name is Sean and this is We Are Investing. And today we're going to talk about Disney stock. Now if you don't want to stick around to the end of the video, I'm going to give you my price targets up front right now. The first price target I have for Disney is $110. This is based off of discounted cash flow valuation. If Disney was to get to this price, I personally will be buying a ton of shares, because this is a traditional approach that doesn't consider a multiple expansion that Disney might get because of Disney Plus. The second price target that I have for Disney 12 months out from now is over $200. I'm looking at a price target of $214.41. This is based off of the projections that I have for Disney and a multiple of 35. Now this is a bullish case, and the only way for this to work is Disney Plus needs to see growth, and the market needs to reward Disney as a business with a higher multiple than it had before, something more comparable to Netflix. Now it is my personal opinion that Disney should deserve a higher multiple because of Disney Plus, but how high will it really go? That is the question. That is the hard part of coming up with a price target for Disney. Now for the rest of this video, I'm going to show you all of the factors that we considered, all of the data that we collected in order to do this analysis. But before we do so, I just want to point out a stellar promotion that WEBULL is currently running. The promotion is, if you sign up with WEBULL with the exclusive link that I have down in the video description, you could potentially get $2,300. This is possible because when you open up an account with WEBULL, no money down, you will get one free stock worth up to $300. Then if you deposit $100 into your account, you will get another stock that is potentially up to $2,000. And on top of that, if you sign up for crypto trading, you will get another $5 worth of crypto. But you have to use the link that I am providing down below in the video description. And it is my honest opinion, I would not partner with WEBULL if I did not think it was a great brokerage. I personally use it, and I think it's one of the best brokerages out there, and probably the best for your phone. So let's hop on over to the computer. Let me show you all of the data, all of the entry points, so that you can have a better understanding of how I'm coming up with these price targets for Disney. All right, let's just dive right into it, mi gente. Let's take a look at Disney stock. Now the first year projections are going to be 2022. The weighted average cost of capital is 7%. This is based off of Finbox, which they gave us a low of 6.3, a mid of 6.8, and a high of 7.2. I'm using 7% in my analysis. The shares outstanding is 1.82 billion. The perpetual growth rate that I'm using is 2.5%, and the current market cap is around $269 million for Disney. Everything else is data that you can pull from WEBULL, Yahoo Finance, or other sources. Now there is something that stands out, and we're going to take a look at this in further detail in this video as well. But free cash flow, which is extremely important when doing a discounted free cash flow analysis. In 2018, free cash flow was around $9.8 million. In 2019, it dropped to $1.7 million because the company invested a lot of money in Disney Plus and acquisition of other companies. In 2020, it was $3.6 million, and in 2021, it's currently $2 million. This company spent a lot of money getting Disney Plus ready, and then it was hit by the pandemic, and that's why free cash flow has dropped so much. But if we take a look at the data that I have for Disney, and I have it all the way back to 2010, I pulled all of the data from 2021 to 2010. If we take a look at the annual free cash flow, it was on the up and up. In 2010, it was around $4.5 million. And you got to account for inflation here as well. So if they did the same business today, the free cash flow would be worth more. But we could see that it was on a constant, or not a constant, but a pretty good move upwards. 4.4 to 8 to 8.7 to 9.8. And then we got hit with the Disney Plus, which was well worth the money, and the pandemic. And since we're in this tab, let's talk about this data because there's some other factors to consider. Like year-over-year growth in annual revenue. Since 2010, the average is 5.5%. The year-over-year growth that I'm going to assume in my projections is 5%. Something else that we need to consider is annual net profit margins. Now, the annual net profit margins, the average over all of this time is 15.29%. I'm going to use 15%. There were years where net profit margins were 16.5%, 17%, 20%. So maybe 15% is too low, but I'd rather be conservative in my analysis and come up with a price target that is lower than it needs to be. So that way my chances of making money are greater. The next thing that we need to consider is net income to free cash flow as a percentage. The average is 81.17%. For my analysis, I'm going to be using 80%. So when we take a look at this key data, everything's plug and chug. There's not really much more to talk about on this slide. But if we go to step 2 and we go to projection inputs, how we are going to determine what the free cash flow is based off of growing the revenue, using that net profit margins, the average of 15%, and then net income to free cash flow at 80%. We're also going to grow revenue 5% per year, and we're going to have a terminal growth rate of 2.5%. For 2022, we're assuming that the company is going to make close to $71 billion in revenue. And in 2025, we're going to assume that the company is going to be pushing $82 billion in revenue. This is a compound annual growth rate of 5%. From 2022 to 2025, I'm assuming 5% growth. And that is not unrealistic when you consider the history. If we take a look at the history of year-over-year growth, there are many years where we're well above 5%. And based off of this calculation, when we take a look at the results, we can then gather what free cash flow is going to be. In 2022, we're estimating that free cash flow will be $8.5 billion. In 2025, we're estimating that free cash flow will be $9.8 billion. This is also not unrealistic because if we take a look at the data and we look at annual cash flow, back in 2018, annual cash flow was $9.8 billion before it dropped a ton. Now, when we factor in all of the considerations that we have made, the discounted free cash flow valuation for Disney, in my personal opinion, is around $110. And if the stock was to hit that price, given the considerations that we made that I think are pretty conservative, I think Disney is a very strong buy at around $110. And honestly, that evaluation does not account for any expansion that Disney Plus might have on the share price of Disney stock. So really, when we consider the technicals and we take a look at the charts, I like Disney at around $125. That's when I personally would start trickling into a position in Disney because at that point, I'm really liking the risk to reward ratio. And if it gets to $125, then I can start dollar cost averaging my way in. Now, I like the risk to reward ratio because of the other price target that I mentioned in this video. Now, this is based off a price to earnings approach. Now, if we take a look at the PE ratio for Disney and we take a look at the average and just follow my screen here. Back in 2017, we were around 13. Back in 2010, we were around 16. Back in 2012, we were around 15. Back in 2014 or 15, we were around 21. It dropped a little bit. 2017, we were at 18. We were at 12 or 13 in 2018 as well. Then we saw a little bit of an expansion. In 2019, we were at 24. In 2020, we were at 36.59. It dropped because we had no earnings because of the pandemic, and now it skyrocketed to 283.5, which is unrealistic because, again, earnings are suppressed because of the pandemic, and the stock market was looking ahead of that. And right now, we're at 135.88 based on today's values. So what I want you guys to do is I want you to basically discard all of this because it's out of whack because of the pandemic. And based on what we had before is Disney was around a 15 to 20 PE ratio, but that's not accounting any kind of growth from Disney Plus. Now, because the stock had a PE ratio of 24 back in December of 2019, before the pandemic and before Disney Plus really took off, I think 25 is a good base number. Now, we need to take a look at Netflix because if Disney Plus was to take off, Disney stock is going to get a valuation that is closer to Netflix on a PE ratio basis. Now, if we take a look at the PE ratio for Netflix, Back in 2019, it was around 25, but then you see a major expansion. And we had PE ratios of 408 at some point. But right now, it's currently at 60. So if Disney gets half of the valuation of Netflix, that would be a PE of 30. If Disney was to get 2/3 the valuation of Netflix, then the PE ratio for Disney would be 40. So we're looking at a PE ratio of anywhere from 30 to 40, which would have a big difference in the share price. And if we go back to that PE ratio of 25 that it was back in December of 2019, the share price of Disney would be $153, which is basically where the stock is trading right now. But if we were to use a 30, which is half of the PE ratio of Netflix right now, we're looking at a share price of $183.78. If we were to use that PE ratio of 40, we're looking at a share price of $245.04. And if we split the difference and we use a PE ratio of 35, we're looking at $214.41. That's currently what I think Disney could potentially get to, and that's where I would be selling the stock. And that would be a 45% return on your investment in about a year's time. If it was to get to that 40 multiple, like we said, you're looking at a 65% return on investment. If it gets to 30, you're looking at a 24% return on your investment from the current share price. And at that base case of 25, you're looking at 3.61%. Now, let's say we wait till the stock gets to $125 a share, and then we start entering into a position. That base case at 25 looks way more attractive at a 22.52% return on your investment. A 30 PE ratio gives you a 47% return on your investment. The 35, a 71%, and the PE of 40, a 96% return on your investment. And if we were to change the current price to $110, basically getting in at the discounted free cash flow valuation, we're looking at a 122.76% return on your investment for the bull case. So the takeaway from all of this is that there is definitely potential in Disney, but how much are you willing to pay for that potential? That is the question that you need to answer for yourself. Now, if you like this spreadsheet and you want to have access to it, you can do so by joining the Patreon. A link is provided down below. When you join the Patreon, you get access to spreadsheets like this. You get access to a Discord server of over 500 investors where we talk about stocks and cryptos every single day. You also get access to weekly reports of the top stocks that I see for each given week. It's $5 a month, and the link to the Patreon is provided down below. I'll catch you all on the next video. It's been real. It's been fun. It's been real fun. And this is We Are Investing, and together we are invincible. See ya.